Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Trading foreign exchange is a crucial part of international investment, but as an adjunct to investing, typically it represents a cost to investors. David Scilly, head of fixed income and currency dealing at First State Investments, is here to discuss how asset managers can employ automation in trading to increase its efficiency. David, welcome back to Trader TV.
Thanks for having me again, Dan.
So tell me, how does FX trading relate to other instruments, and is it just a cost?
Certainly when you're looking at it from the point of view of just buying or selling a security and actually needing some, kind of money to actually pay for that security, you could argue that it is just a cost. But one thing that people probably don't understand is that if you're taking on currency risk, the currency decision and the timing around the currency execution is just as important sometimes as the investment return on that local asset. Obviously, you still have to be concerned about liquidity. You have to be worried about market impact, the transaction costs, all these things. But obviously, the structure of the FX market's a little bit different.
Yeah.
It's a little bit more evolved. There's a lot more electronification. There's a diverse range of market participants. You're talking about everything from retail through to wholesale. And then it's also a very fast-moving market. So you have to actually be a little bit more reactive and have different approaches to execute different strategies.
And does it have some of the same challenges you have with implicit costs and explicit costs?
It does have implicit and explicit. It probably is more what is my cost that I can actually see right there at that point in time versus what my slippage and also my market impact is so not just the time that you're doing the trade, but it's also the market movement after you've done that trade.
What constitutes best execution in foreign exchange?
You need to understand the liquidity that you're actually participating in and where it's coming from. You also need to be very transparent, obviously, in how you actually show stuff to the market, how you signal to the market. And finally, you need to actually provide evidence, if you like, on your execution decision about why you made the decision you made to execute that particular way.
And how would you characterise the FX markets over the last 12 months?
Bid-ask spreads have definitely narrowed in developed markets, and in emerging markets, there have been some cases where they've widened depending on the geopolitical risk. Banks have, for some time now, had reduced risk appetite. But what's actually happened is because of the electronification, because of the expectation from the buy side as well about the pricing that they expect to see, banks have actually increased their transparency in terms of what they're showing in terms of live executable pricing. They've increased the size and the limits at which they're prepared to show on screens, which are executable prices. And they've also been quite prepared to clear that risk at probably a faster level. So whilst they haven't warehoused that entire bank risk, they've actually still been willing to offer good transparency, but the risk gets cleared in a much quicker fashion than it used to.
You mentioned that banks have less risk appetite. Why do they have less risk appetite in FX compared to other sort of more risky assets?
They have less appetite for warehousing some of the risks now, and I think that's been the case for quite a long period of time. But they are offering us quite a large size now on screens and executable kind of levels on screens, and they're being very transparent with that. So I think that what's happening is they're finding better mechanisms in order to clear their risk.
How's that affected the way that buy-side traders are interacting with FX?
So you need to be aware of a few things. I think you need to be using all the execution strategies available to you. You have to understand the liquidity, as I said, that you're interacting with. You have to be aware of algorithms and how you can use algorithms. At times, you have to be aware of who you show certain prices to. And as I said, you have to be aware as well of that market impact or the slippage, if you like, that will happen after that trade has been executed. Out
of interest, if there's a capacity to automate more in FX trading, is it worth investing in systems to make that happen, or is that something typically the sell side provide?
The sell side has actually increased its level of automation just by the pricing it's shown, which has been great. And they've definitely increased their size in terms of what they're prepared to show on screens, which has obviously provided more opportunity to use that. I do think that more automation could be done from the sell side in terms of the currency pairs that they're currently showing, understanding that obviously they can't show prices, all the time in every currency pair that's available.
Sure.
It has been increasing, which has been a good sign. And I think that ultimately we want to get to a point where we can interact without necessarily having to get on the phone and make the call on that risk transfer price, but just interact with the electronification they're providing.
And are the underlying economics for supporting automation less interesting on the buy side because FX is not an investment, it's a cost of investment?
That's a fair point. I haven't really looked at it that way, I have to say, because obviously, for me, FX is a very important part of our business. Like, we have active capability as well. Having said that, you're right, it is something which everyone needs to do. So what you need to do is obviously try and lower the cost as much as you possibly can. The easiest way to do that would be to increase that transparency give buy side or empower the buy side to actually be able to make those executions themselves without actually affecting, their impact and their reputation on the market by doing so.
So you've got a drive for greater efficiency, you've got implicit and explicit costs to manage. How are you tackling those challenges?
Trade cost analytics are really important in FX, both pre-trade and post-trade. We're looking at trying to assess and then looking at the opportunity costs, which when you're getting prices in real time is very hard to distinguish sometimes. It's hard to kind of model both scenarios and try and work out which is the better scenario because it is in real time. But that's the way we're trying to tackle it, is we're trying to look at how we approach one execution decision, look at the cost of that, and then trying to assess it, if you like, with another execution decision at that point in time to try and work out whether we would have got a better outcome. That's where TCA and some of the modelling in TCA is actually very important to help with that.
Are you using anything like the auto-hedging capabilities some of the platforms are offering?
We're not doing that yet. We tend to use our own tolerances and kind of manage those decisions ourselves. Again, because we like to have control over the size and the liquidity and the timing of which we do that FX execution, so we're not currently using that auto-hedging.
And so how would you say you're increasing execution quality and efficiency for investors over the longer term?
So we're assessing those opportunity costs and those different scenarios, as I suggested. We're looking to try and minimise the market impact that we're having in institution as much as we can. But the key part of it is this continuous improvement piece, which is to look at the execution that we've done, compare it to the scenarios that are available to us, and making sure that we're actually reducing costs in the long term for the client.
David, thank you very much.
Thanks for having me.
I'd like to thank David Scilly of First State Investments for his insights into FX trading, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net and etftv.net.